I don't know. I mean, now we are on the live stream, so it's better to switch in English.
Very good.
But it's good. We will probably start at 8 p.m. sharp. But it's currently vacation for a lot of us. I think the academic year already started in Paris.
For some of the students, yes, indeed, it has started recently, but for some others, it starts next week. Yeah.
Okay. Yeah, then it's still late because for us in Belgium, it's quite different between the French-speaking students and the Flemish students. And the Flemish students, we start the last week of September. And the French-speaking one, they start next week.
Okay.
So because I'm considered as a Flemish student, I am now on a break. So I'm currently in Marrakesh. That's my aunt's place. Like it's very nice. Very enjoying the sun and the.
But didn't you suffer from the earthquake?
I was not there yet. I came yesterday. But where my aunt lives, it's at the other side of the earthquake. So the earthquake was around the southeast of Marrakesh, and my aunt lives in the northwest of Marrakesh. But they felt it. But there were no direct consequences. But now my aunt and other people are helping the people who got problems with the earthquake. That will probably also contribute my my little piece to it tomorrow.
Good.
Yeah, but I only arrived yesterday evening. But yeah, it's gonna be nice. By the way, Olivier, do you have a presentation or something? Normally you should be able to share your screen.
So I'll share my screen. Do you want it? I mean, I think I'll share the full screen like this. Boom. I just need to verify like this. I just need to verify that there is a link at some point. Just need to verify it works. Start at 8 sharp. Here, if I do that, it works fine. Okay.
Okay, cool. Yeah, we will start in 4 minutes. I also see that our big friend Yad did join.
Hi.
By the way, Olivier, Thomas and Yad are both board members for our Paris branch. So Thomas will be the president and Yad will be the head of quant research, because that's also something we are aiming to do. So next to our lectures and normal events, we will also dive a bit deeper with like smaller groups on research topics, where some of us will start with already existing academic literature and then try to, for the papers that don't already have codes, try to write the code, or others will try to find something completely new. And we are now in discussion with the company to work together with them on those.
Yeah.
But that will be our focus for the coming
year.
year.
It's I mean, this exists in France. It's called a junior entreprise or junior consulting or stuff like this, and it's nice. Where are you, Yad? You are at NSAE?
Yeah, no, I'm at Paris-Saclay, Central, and NC.
Okay.
Yeah, but now currently I'm at Paris. So
no, I was not asking that. How do you study?
Yeah, but I'm pursuing the PhD at Paris-Saclay.
Okay.
I mean, I did the PhD after I joined Société Générale. I mean, I was your student at NSA at the Master SFA.
Yeah, that.
Yeah.
I kind of remember. This is why I ask.
Yeah. Afterwards, I went working for a year at the Société Générale as a quant. Then the Professor William Pham proposed me to Horizon Software, that proposed the CIFRE thèse with Vatin Livat and Etienne Chevalier. And so I went pursuing the PhD with them. Yeah.
Okay, so you're based in Evry, I guess, when you work with them.
Yeah. Evry and GIF sur Yvette.
Yeah, Superlec and Central. Okay.
Yeah, exactly.
You know the RERB by heart.
Yeah, actually, I don't use it anymore. I go to Paris 7, LPSM.
Yeah.
It's much easier for us to meet at Paris 7 rather than go to GIF sur Yvette. Yeah. But I will send you my first paper. Actually, it's going to get published soon.
Yeah, let's wait for one more minute and then we can start. Normally, I will just check if the live stream worked, but normally it should.
And then there is a rediffusion, right?
Yeah. So the live stream will, so the recording of the live stream will be accessed. Everyone will be able to access it on our websites. So when they click back on the event, yeah, it's posted automatically, unless you prefer not to. And then
if you can remove the first minute, it's fine.
yeah, I will cut it. Yeah, let me just check if the live stream works, and then we can start. Yeah, live stream works. So I suggest that we start. First and foremost, thank you, Mr. Olivier Guéant, for making time for us to give this presentation. So for the audience, Olivier Guéant is a professor at Institut Polytéchnique in Paris, and also a full professor at Université Paris 1 in applied mathematics. Olivier holds a master's in mathematics from École Normale Supérieure. And then I believe he also pursued for another master's or another degree at Harvard. And then after that, he went for his PhD at Paris Dauphine on, I believe, mean field games in economics. So with no further ado, thank you for making time for us, Olivier. And I will hand over to you.
Well, thank you very much. I think it's a very nice initiative that you have to organize conferences, trips for students to go deep into quantitative finance. So today I want to talk about automated market making. I will share my screen. Share my screen. You tell me when you see. Do you see?
Yeah, we can see it.
Okay, very nice. So I said I'm going to talk about automated market making, but in fact, I will talk about first market making, then automated market making. And beforehand, I want to talk about how I came to work on market making, because I think it may be interesting for you as a student. I remember 20 years ago when I was a student, so you can guess my age now. But I think I would have loved to have some advices, so I will give you some. So you said everything about me, but I want to insist on something. I'm a professor of applied math, as you said, at University Paris 1 Panthéon Sorbonne, but I'm in an econ lab. I'm a member of the Centre d'économie de la Sorbonne. So the key word is economics. And I'm in charge of the financial team. So you see in 3 bullet points, you have mathematics, economics, finance. And I'm also, as you said, adjunct professor of quantitative finance at INSAE, Institut Polytéchnique de Paris, as it is called now. And I want to insist on something, which is multidisciplinarity. Here, for me, it's mathematics, economics, and finance. And I think it's a keystone for good applied research. And this multidisciplinary stuff started when I was a student. Students of my generation, I think it's a bit different right now, but students of my generation were invited to follow courses in several fields. So in my case, I did, of course, math and economics, but also a lot of computer science. And I wrote several master dissertations to give you, like, at that time it was more common. Today it's less common. But I wrote something on Gaussian spaces, chaos decomposition, Fock space. So well, it's related to quantum mechanics, but it has nothing to do with it. It's really probability. I wrote some, so this was math and probability. I wrote something on financial innovation, GDP indexed financial products. If you know the book by Schiller, Robert Schiller, which is called which is entitled Macro Market, it's linked to this. And I also wrote something on environmental economics or environmental finance about the right discount rates, the discount rates that are compatible with the existence of environmental goods. So I was not really in quantitative finance at that time. I had all the tools because I did probability. I knew some economics. I knew a bit of finance, but I was not in quantitative finance. Maybe I should do this. Yeah. And my PhD dissertation was not on finance, quantitative finance either, even though there were applications to finance, but it was, as you said, on mean field games and on applications of mean field games to economic problems. So if you see here, once again, it's multidisciplinarity. Games are basically in economics. Game theory is a field of both economics and mathematics. Mean field is a keyword that you usually find in physics, and it was applied to financial and economic problems. So once again, there are really interesting stuff to do at the frontiers between domains, and I think it's an important stuff, and it remains true now. To tell you a bit about mean field games, because it's quite it was quite fashionable and it's still quite fashionable. Also, I'm a bit critic about it right now, but it was a new paradigm at that time for studying strategic interactions. Like in game theory, you want to understand, you want to find Nash equilibria, if you know this notion. But the thing is, it was, I mean, we were talking about games with infinitely many players, hence the notion of mean field. Like you have a lot of particles that you summarize somehow with a mean field. And the tools were the tools of stochastic optimal control, so tools that are useful in quantitative finance, variational calculus, so something linked to optimization, PDEs, also quite important in quantitative finance, especially Hamilton-Jacobi-Bellman equation, but there were also transport equations like Fokker-Planck equation, also a lot of ordinary differential equations. And it was a very interesting field with lots of works. There are a lot of work on it right now, but for me, modeling with mean field games was often rigid. If you know rational expectations, they have been criticized a lot, but you are in this framework of rational expectation. You have to have Nash equilibria at all time. And my opinion developed, evolved in the sense that I think it's a relevant paradigm for some stationary problems, but it's often questionable for studying dynamics. I mean, sometimes people study mean field games, model populations by mean field games, but you have to assume that everybody knows everything about everybody, and it's a bit far-fetched. It's a bit extreme. So I didn't like it that much at the end. And because Jean-Philippe Bouchot gave you a talk, I think last year, the last talk of the year, I wanted to do a transition with this year. I quoted a sentence, or in fact several sentences that he pronounced, which I think are very interesting, from his leçon inaugurale at Collège de France. So it's in French, and I will translate, like I asked Google Translate to translate, but I will explain what it says. He said, les modèles servent souvent de paradigmes sur lesquels les disciplines se développent. Certains modèles, certaines théories creusent dans nos esprits un sillon si profond qu'ils déterminent sur le long terme notre conception du monde et nos pratiques professionnel. He says basically that a model is not only a model, but it determines our conception of the world and the professional practices. And he adds then, il n'est pas rare, and this is, I think, the most important stuff for you as a student, not to be fooled in some sense by models. Il n'est pas rare que la beauté formelle d'une théorie, son esthétisme mathématique, prenne le pas sur sa pertinence à décrire le monde. So it's basically, it's not uncommon that the beauty of a theory, its mathematical aesthetism or beauty, takes precedence. So it's more important in some sense for some people than the relevance to describe the world. And this is really a danger with mathematical modeling, is sometimes to be stuck in the math and forget that the real goal of what you do is to model the world in a meaningful way. And he said, he had, une recherche hors sol en vase clos se développe alors, dont la justification devient l'investissement intellectuel déjà consenti. And I really love this last sentence, which says, research develops in isolation, and the justification for that research is in fact only the intellectual investment already made. So they continue to do that in many fields because they have already done that, and there was somehow a cost to start to do that, and so they continue because they did that. Okay, so it's really like a capital that you invest, and you don't want to basically have the feeling that you wasted your capital, so you continue to invest in some sense in this thing. So I think it's important, and every time you are presented a model, think about whether it's something that really makes sense or something that is just like follows a tradition. And it's, in the case of Jean-Philippe, he was really criticizing the way economists make their job in some sense, but it applies, I think, to many fields, and it's always important to keep that in mind. So back to MFG, I was maybe not that extreme, but I was not satisfied by Minfield Games, and I wanted to do something different, more related to finance. So here I come, quantitative finance, and I was working with Jean-Michel Lasserie, one of the two fathers of Minfield Games, and I think one of the most talented persons I met regarding mathematical modeling, and he introduced me to Charles-Albert Lehal. Charles-Albert Lehal was at that time quant at Chevreul, but then he went to CFM, and now he works for ADIA, Abu Dhabi Investment Authority. And he showed me, it was back in 2010, I would say, or something like this. He showed me a paper by Avellaneda and Stoikov that was published in 2008, and he asked me my opinion. And basically, I really liked the paper, not the way it was written, really, but I really liked the field. I really liked the questions that were asked, and it was the beginning of a great journey in the field of market making. So it's still not DeFi, decentralized finance. It's just market making. But before I talk about market making, I need to say a word about the organization of markets. I'm pretty sure you know most of the thing I'm going to say, but it's better said. And so basically, markets are here to help people transact, because they must be organized, otherwise just the intermediaries, they really get too much. But to organize a market, you have several possibilities. You can do auctions. So if you think of, paintings, some furnitures, they are sold sometimes with auctions. But also in finance, you have auctions. At the opening in the morning, at the close, for instance, you have also recurrent auctions. You have auctions during the day if there was some event and the market stopped. There are plenty of auctions in finance. You have also a dealership organization where market makers or dealer, they propose quotes to clients. So you have on one side market makers or dealers, and on the other side clients. And it's an old job. If you think of the cleansing of the temple, there were already somehow market maker for the shekels. The FX counters in the streets or in airports, they are proposing a price at which they were okay to buy. they are proposing prices at which they are okay to buy, prices at which they are okay to sell some currencies. Most OTC markets with request for quotes are like this, like FX, or part of FX or corporate bonds. It works like this. It's electronic because you have multi-dealer or single dealer platforms, but still it works with requests. Then you have what is the most known case. It's all-to-all limit order books. Everybody can participate to the limit order book, and you have pre-trade transparency in the sense that you see what is in the limit order book. Of course, today it goes too fast, so you see something, but it may not be what is inside the limit order book right now. But at least theoretically, you have pre-trade transparency, and you have also some limit order book or some other mechanism in which you have no pre-trade transparency, like dark pools. So you have numerous ways to organize markets to help people transact. And as I will explain, in crypto, in decentralized finance, there is a new paradigm, which is called AMM, automated market makers, that is really not one of these organizations. And I will explain how it works and what we contributed to do on this. Just to show you that everything is complicated, this is a diagram of the organization of the FX market. I took it from Shrimp and Sushko. They are working, I think, at the BIS, the Bank for International Settlement. And so you see here, there is a dealer to customer or D2C market where some clients can request prices to dealers and can basically click on the prices streamed by dealers. It goes through single bank platform. It goes through multi-bank platforms. Then the dealers, they can also unwind part of their position by trading between one another, sometimes directly, sometimes through voice brokers, sometimes through electronic platforms. That's the IDB market, inter-dealer broker market, or sometimes D2D market, dealer-to-dealer market. And here you have plenty of platforms, plenty of dealers. So if you think you know how the market works in FX or in equity, basically, it's not true. And I don't say that nobody knows, but really, it's rare to know everything, and it's complicated. So here, this is what I said. You have an OTC segment, over-the-counter segment. You have access to multiple platforms, dealer to dealer, all to all, some limit order books. It's really, I can say it's a mess. Maybe it's a mess, but at least it's complicated. So let's go back to market making then. Avellaneda and Stoikov, because that's the basic model. The basic model really is a model that dates back from the 80s. It's a model by Ho, H-O, and Stoll, S-T-O-L-L. They wrote 2-3 papers in the 80s, and Avellaneda and Stoikov got inspired from their paper and revived basically the model. But what I'm going to present is closer to Avellaneda and Stoikov. So they wanted to model, the title is High Frequency Trading in a Limit Order Book, but what they wanted to model is the market making business. So a market maker is somebody or an algo providing bid and ask prices to other market participants. So prices at which they agree to buy and prices at which they agree to sell. Of course, usually they buy at a lower price and sell at a higher price. And of course, because of what I just said, they make money out of the bid-ask spread. So they capture part of the bid-ask spread. Okay? So that's the money they make, but of course, it's a compensation for a service they give. And basically the risk they have is that they hold inventory and face the risk that prices move adversely without them being able to unwind their position. So what it means is that if, for instance, they bought something from somebody, okay, but they are afraid of basically the paper going down, okay, and also nobody coming to buy what they just bought, okay. So that's basically the problem of a market maker. There is also the problem of adverse selection. When you trade with somebody, maybe that somebody is more informed than you are. this is another problem which is not dealt with in Avellaneda and Stoichkov. Avellaneda and Stoichkov is just about inventory management. How do I quote, okay, to manage my risk and make money? And unlike what the title suggests, it's a very good model, not for limit order books, but for OTC markets. If you want a model for limit order books, you need to have tick sizes, because the price in limit order books are discrete, and you have some priority issues because in a limit order books you queue inside the limit order book. So you have nothing like this in Avellaneda and Stoichkov, but it's a very good model, for instance, for FX dealers or for corporate bonds dealer who propose prices for to clients. And most of the banks who do that job, they try to automate what they did, and they use model similar to, inspired, I would say, from Avellaneda and Stoichkov. The trade-off is the same. So let's do a bit of mathematics now. At least if it's not mathematics, it's equations. In all these models, Avellaneda and Stoichkov, all the models I did, all the model also done by Cartea and J. Mungo, for instance, you have a reference price process. So it means that maybe you can't trade at that price, but the price is around that price. Okay, it can be, if you have a bit of knowledge about the corporate bonds, you see there are some composite prices that are calculated by computed by Bloomberg or by market access. They are called CBBT or CP+. They tell basically everybody where the market is. Okay, but it's not the price at which you can trade. It's just indicated. For FX, you can look at the large platforms like EBS or Refinitiv to get a mid price, or you can make your own homemade composite if you're a dealer, but you need a price like this. I will explain why you need a price like this, but you need a price like this. And you will propose as a market maker, you will propose price at which you agree to buy, STB, and price at which you are okay to sell, STA. So B is like bid and A is like ask. Of course, a priori you're going to have a minus here because you are going to buy at a lower price than ST and you are going to sell at a higher price than ST. Okay, so the increments, the premium, in some sense, delta TB and delta TA are chosen by the market maker, but he is always reasoning as a reference to ST, the reference price. Okay. Now, of course, you are a market maker, so you are going to propose price at which you buy, price at which you sell. There will be people coming. Okay, and I assume in this model that the size of any trade is delta. Okay, so my inventory is going to be Q like quantity, and it's going to evolve in a very simple way. Every time I buy, it increases by delta. Every time I sell, it's going to decrease by delta. And here, these things here, they are like Poisson processes. If you know Poisson processes, this is equal to 1 or 0, and it's equal to 1 when there is a trade. But the question is, when do you have a trade? When do you have a trade? Well, you have a trade whenever this quote is accepted by your client. And of course, if you propose to buy at a very low price, nobody will come. But if you propose to buy at a very high price, there will be many people coming. So the probability that this process jumps is a function of delta, and it's a this is why there is a minus and a plus here, is to have this function, the probability, or in fact the intensity, a decreasing function of lambda. This is what I say here. It's what we call the intensity of the two jump processes or point processes. They depend on the distance to the reference price. And there is an indicator here to say that basically, if my inventory is already above some high inventory, I will stop buying, and same thing, I will stop selling whenever my inventory is below a given inventory. You can go long and you can go short. There is no problem for the markets I have in mind and Avellaneda and Stoichkov had in mind. Okay, so here the function is decreasing. it really means that if I propose a good price to the clients, there will be a lot of clients. If I propose bad price to the clients, there will be only a few clients. Quite natural. If I look at the cash process, so it's really a story of left pocket with cash, right pocket with asset. Every time I buy, it's like I transfer cash. I convert cash into assets. So whenever I buy, I spend money. Whenever I sell, I get money. Okay, and if you look at the equation, it works like this. But my P&L at time capital T, I need a final time here, but it's a bit arbitrary. It will be the cash I have at the end of the period, capital T, plus the number of assets I have at time capital T, times the price. I value everything at this reference price. And if you look at it, that is, if you differentiate, you get that this is your initial portfolio, okay, plus two parts. One is this. It's a stochastic integral, but with respect to a point process. Imagine it's like when it's one, you account for it. So it's in fact, this integral is in fact a sum, and you just sum the money you made compared to the reference price, okay, at the bid and at the ask. So that's the money you make. And then, of course, there is a risk. It's the inventory risk. And this inventory risk depends on basically the price risk, so the Brownian motion that you add in the price, and QT, your inventory. Of course, if you have no inventory, there is no risk. But if you have a long inventory, you're afraid of the price going down. And if you have a short inventory, a negative inventory, you are afraid of the price going up. Okay? So that's the idea of the model. So that's the equations of the model. If you want to do market making, at some point you need to write equation like this. But now, Haviland and Stoikov or other models like this one that I call Model B, which was in fact introduced by Cartea, professor at Oxford, and Jemungal, professor at Toronto, you need to optimize something. You need to find the optimal quotes to optimize something. So if you study economics, you know, sometimes in economics, people like expected utility. And one utility is called CARA. It's just a minus exponential minus. And when the risk is Gaussian, it's exactly like mean minus a constant time variance. So it's like a mean variance optimization criterion. But when you talk to practitioners, they do prefer to say, okay, let's maximize the expected value of my P&L and some proxy of the variance, okay? And here the variance is approximated by the quadratic variation. Maybe it's too technical, but it's approximated by the quadratic variation. And so I'm going to optimize something like this. When you take the maximum of the expectation of some process where the thing you maximize upon are basically driving the processes, this is called stochastic optimal control or stochastic optimal control. And basically the equations associated with, to solve this problem are called the Bellman equations. So that dates back to the 50s, or Hamilton-Jacobi Bellman equation, or simply Hamilton-Jacobi equation, if you are in continuous time like here. This is just another line to show that with this P&L that I wrote here, okay, you can simplify the moment here. So you can introduce what is called a value function. It's really something linked to stochastic optimal control. So you are going to introduce a value function, and this value function solves an equation, which is usually called Hamilton-Jacobi or Hamilton-Jacobi-Bellman equation. And for most of the models you have in finance, it's a PDE, a partial differential equation. But here we are somehow lucky because, well, there is a partial derivative with respect to t. But if you think of the model, the variable q, which is my quantity, I said either I buy a quantity delta or I sell a quantity delta. So in fact, Q is discrete. It's 0, delta, 2 delta, 3 delta, 4 delta, and so on and so forth, or minus delta, minus 2 delta, so on and so forth. So in fact, this thing is a system of ordinary differential equation. It's a nonlinear system of ordinary. It's a nonlinear system of ordinary differential equation, but it's still ODE, not PDE. Just, I didn't mention it, but this is called the Hamiltonian. The function h here is linked to the intensity that I introduced before. I don't want you to focus too much on this if you don't know stochastic optimal control. It's just when we have a stochastic optimal control problem, we introduce a value function. It solves. This is not 100% true, but it solves an Hamilton-Jacobi equation. The truth is that if you find a smooth function that solves this function, it is the value function. And then from that value function, you can get the optimal control. I will explain how to proceed. So what I said, well, first, I presented you two models. The equations are almost the same. Something important, it's a system of nonlinear ODEs. And I showed that basically this system is well defined under very basic assumptions. It's in a paper which I wrote, which is called Optimal Market Making. I think it dates back to 2015 or 17, 16 or 17, I don't know. So basically all the math, everything is clean, all the math is okay. And if you want to have the optimal quotes, you simply need to solve the equation for theta and plug basically what you get here, the differences, in a function delta, which is quite technical, but it's the inverse of the function lambda, which was a decreasing function, if you remember well, composed with the function h, which was an Hamiltonian function based on lambda. It's in fact the derivative of h. But don't focus too much on the equation. What I want to say is that once you have theta, so you can use an implicit scheme for theta or any scheme you like, then you simply need to plug the theta and you get the optimal quotes. Something interesting that we did back in the time with Charles-Albert Lehal was to consider, as in Haviland and Stoikov, exponential intensities. Exponential intensities, GLFT means Guéant, Lehal, and Fernandez-Tapia. Joaquin Fernandez-Tapia was a student of Gilles Pagès, if you know Gilles Pagès from Paris 6, from Sorbonne University. And we wrote a paper solving the model in the exponential case because you have closed form solutions. So if you believe that basically the lambda, or if you estimate that the lambdas are exponential, so it means that when you improve the price, you get more clients, and this is true in an exponential way. Okay, then the function h can be solved in closed form, the function delta, same thing, and your system of ODE works like this. It looks dirty, but if you look at it, here it's exponential of theta minus theta, okay, for different parameters, but exponential a minus b is exponential a divided by exponential b. So if you change the variable, if you write vq of t equal the exponential of theta times the constant in front of that, you get a linear equation. You get a system of linear equations, and it's in fact a three-diagonal system. So this is quite unique, so to say, in optimal control. Usually you start from something which is an Hamilton-Jacobi equation, which is really nonlinear, and here it's kind of a miracle. It's linked to, there are deep reasons why it's like this. It's linked to some entropic penalty in a dual version of this, whatever. But there are some reasons why it becomes linear. And when you have a linear equation, well, you simply take the exponential of a three-diagonal matrix here to solve the system. And so what I basically say is that it's really complicated. in terms of mathematics to go from the beginning to this, but at the end of the day, it's 5 lines of Python, because you simply take the exponential of a matrix, and the optimal quotes at the bid is just this formula here, and the optimal quotes at the ask is just this formula here. Okay, and we even, because when you have something which is linear, you can use some spectral analysis, and with spectral analysis we found some approximation of the optimal quotes. So they are not perfect, this approximation, but basically it says that the optimal quotes depends on your inventory, and of course it's quite natural. If you buy, okay, or if you bought, what you are going to do is increase delta B and decrease delta A, which means that you are going to propose a lower price at which you agree to buy. You bought, so you don't want to buy again, otherwise there would be more risk for you, and you want to sell at a better price because you have a risk and you want to unwind this risk. You want to remove that risk from your portfolio. Okay, so it's quite natural, and here it's linear in Q, and you see that there is some dependence on the volatility, on your risk aversion. I mean, you can look at the papers if you want to have more details about this, but this is just mathematics. It's interesting. It was quite a good time when we managed to solve this. But if you want to really have a model for market making in practice, you need to account for many features. Okay, and I can list a few. But first, sizes. Transactions are not all of size delta. There are plenty of sizes. You need to take that into account. If you are a dealer, a market maker, usually you know your clients, and you can propose different prices to different clients. Okay, if for instance you have a client and this client seems to be well informed all the time, you trade with him, the market goes against you, but maybe next time you will not propose the same price. Okay, or sometimes you have different relationship with different clients, so you can do client tiering. Of course, here the model was just Gaussian. You can do plenty of different things if you know all the stochastic vol models, even just instead of arithmetic Brownian motion, do geometric Brownian motion. It's possible. For liquidity, here liquidity was somehow symmetric, but I don't know what Jean-Philippe said to you last time, Jean-Philippe Bouchot said to you last time, but for instance, we know that in many markets, there is autocorrelation of the and even long range autocorrelation of the signs of trades. So it means that when there was a buy, the chance that there is a buy is higher. Okay, so liquidity is asymmetric and variable as well. So you can do extension of this. When you're a dealer, as I said, remember the graph for FX. You can just wait, as in Avellaneda and Stoikov. If you bought, you wait for somebody to buy the inventory you have. But you can also contact by yourself, be more active and contact other dealers, go on some markets, on platform to externalize your flow, your inventory. But in that case, you have market impact. You also have the problem of adverse selection. When you trade with somebody, you're not informed, but maybe that person is trading for some reason. He's buying because he thinks the price is going up, or he's selling because the price is going down. He's selling, you get the asset, and the price is going down if he's right. So you don't like this. This is called adverse selection. So all information asymmetries need to be taken into account. The reference price maybe is not very precise, and you can do better. And also, very important, Avellaneda and Stoikov is just a model with one asset. If you think of even a simple FX model, okay, imagine you have 5 currencies, or you have plenty of currency pairs, and you need to have a model with multi-asset. So this is something, for instance, for multi-asset setting, we have done with one of my PhD students, and then with some quant at HSBC, and also with other banks, we worked on this on on these problematics. So you have to really improve the model and not stay at the basic level of the model with the equation if you want to have something that works really well. If you want to know more about optimal execution and market making, of course, I can recommend my book. I can also recommend the book of Cartea, Gemungal, and Penalva, which is another book which is quite nice. And here it was market making. I just want to show you that we can go complex, okay? And I will show you an animation here where we solve all the equation in the multi-asset setting, and I want to show you what it gives on the market simulator. I hope you see my screen. So here you see, so you have GBP USD, you have, so that's called a cable. You have EUR USD and EUR GBP, you are trading these currency pairs. Here on the bottom right, you have the quotes that you propose. So you propose a price for 1 million, 2 million, 3 million, 5 million, 10 million, 20 million, something like this. And whenever you're long, you see you skew your quotes, okay, to avoid buying again, or you skew your quotes to sell what you have, okay. And here maybe it's hard to see, but you have plenty of red dots. It oscillates. It's a complex animation. It oscillates between EUR USD, EUR GBP. I will run it again. So the three, the two pairs with USD and what we call the cross. And here you have your position in the GBP USD and EUR USD plan. Okay, here it's where you are, and you can check when you are short euro. You propose good prices to buy euro, and when you are, for instance, long GBP, like here right now, you propose good price to the clients to sell the GBP you have because you want to have zero inventory. And here it's basically, you have to take into account of the fact that all these currency pairs are linked, okay? And here it's what you trade with clients and the proportion that you hedge or that you basically sell on another market if you have access to another market. So that just, I reach here basically the limit of what I can show because I have already 3 pairs. And if I want to show something meaningful, it's complicated to do more. But it's just to show you that the models can really be improved to get to something real. Okay, maybe before I go into DeFi and automated market maker, maybe you want to ask questions because I think it's already a good time if you want to do if you want to ask some questions about market making.
I personally don't have a question. Does someone has a question? It was very clear, by the way. Thanks.
So as you see, I'll go back to the slides. I started just like as a mathematician to work on a paper. Okay, I solved the equation basically and found some closed form solution. It was really mathematics, but to go from this, very exciting task of solving a model to do something that is really meaningful for practitioners, there is a lot to do. And I was in the last project I did for on this field. I worked on corporate bonds. I work on the FX markets. Jointly with practitioners, usually quants in banks, and so FX, corporate bonds, and for some reasons that I will explain, I also worked on cryptocurrencies and decentralized finance. The context is the following. I must confess, I'm not sure it's a confession, but I must say that, like everybody, many times I had a glance at cryptocurrencies, but I was never fascinated about it. I wanted to keep in touch, okay? It's maybe a fear of missing out, but I wanted to know what happened, but I was never hooked on it. I was never really attracted by like getting deeply into cryptocurrencies. But I remember well that time, because it was really 3 days before Christmas, 2 years ago. So of course I was not really doing math, but I was checking my mails, and I received an email from somebody I didn't know, a very nice guy called David Buba, who co-founded an AMM, an automated market maker called Swap, and he basically showed me a white paper about written by his company. He had interesting remarks in the mail, and he sent me something like, "Okay, I want to discuss with you. Are you available?" It was a really nice email, and so I accepted. And less than a year later, we released the paper that I'm going to present today, which you can find on arXiv. If you type my name and for instance, David Buba is a co-author of the paper. It's a nice example of collaboration between academics and practitioners, and it's a nice example also of cross-learning between traditional finance and decentralized finance. And really, David Buba, he really spotted my models, my papers, and he thought that they would apply by changing some stuff, but they would apply to his problem, and he was right. So before I get into this, I want to talk about the difference between the classical mechanisms that I talked about before and AMM. So I told before, you can have limit order books, auctions, dark pools, request for quotes, request for stream. But an AMM is something really different. It's a new mechanism by which traders can swap one asset against another. Today, it's about cryptocurrencies, but it can be anything, in fact. And they do that using a pool of reserves posted by other agents that are in quest of yield. So this agent, they have some ETH, they have some Bitcoin, they have maybe some USDC, they have some cryptocurrencies, and they pool that in the pool, and the pool somehow is doing market making. So you have two players. It's not dealers and clients, but they kind of work the same way. LPs, liquidity providers, they supply reserve to the pool. Okay, usually a pool is made of two assets. So you have, for instance, Ether, and Bitcoin on the other side. And LTs, liquidity takers, they use the AMM to trade. And in the basic AMMs, the exchange rate is based on a predefined formula that depends on the reserves. Okay, of course it depends on the reserve, but they also depend on the transaction size. So if you look at a pool and see there are like X $1 million into it, Y unit whatever of ETH, then given the transaction size you want, okay, and the direction of your swap, it's not a swap like in finance. It's a swap in the sense that you swap something against something else. So it's like trading. It's just you want to exchange in something Bitcoin against USDC. Okay, but there is a pricing function that is written, and everybody can see what it is. Why is it really different from the other ways to organize the market? In dealer markets, what I talked about before, the dealers, the market makers, they are specific agents. They provide liquidity to clients and hold risk on their balance sheet. Here, in the case of AMMs, anybody can provide liquidity to the pool, and so it's like everybody can give liquidity to be some kind of shareholder or participate to a market-making strategy. It's completely different from order-driven markets organized around the limit order books, because in an AMM, the prices are settled, set by the protocol, okay? It's not like agents choosing prices, limit orders at which they want to, the prices of the limit orders they post, it has nothing to do with it. And it's also completely different from dark pools because it's not dark. The available liquidity is completely visible, and the price, as in, for instance, midpoint dark pools, if you know midpoint dark pools, the price is in the midpoint dark pool is defined as the price on another venue. You import the price of another venue. Here, it's not like this. Okay, so it's really something different, and also, but that's specific to this setting. AMMs are fully collateralized in the sense that neither LPs nor LTs are exposed to any sort of counterparty risk. They are exposed to some cyber risk. If there is a problem with the AMM, they are exposed to this risk, but it's not counterparty risk really. So before I go to how we adapted the Avellaneda and Stoikov and the model I did after that to AMM, I want to talk about the classical designs of AMM. If you have heard of AMM, I'm pretty sure you know a company called Uniswap. Okay, this is, I think they are the most important AMMs. I think today it's Uniswap version 3. There are some other stuff on top of version 3, but it works this way. It's a CFMM, so it's a constant function market maker. They are the most popular at that time, and basically the idea is they have a function, okay, and whenever you want to remove delta Q0, my currencies, my assets, if you wish, are 0 and 1, and so I will swap 0 against 1 or 1 against 0. Okay, and the idea is when I swap, I want the function to remain constant. So it means that whenever I remove, it means that I buy some Q0 and I pay the AMM in some sense with the currency 1. Okay, then there will be Q0 minus delta Q0 in the pool after my trade. Okay, and there will be Q1 plus delta Q1. Okay, after my trade, but I want this to be the same as before the trade. This is when there is no transaction cost. If there is a transaction cost, they will ask me to pay more, or they will give me less than Q0. Okay, if you think of the implicit function theorem, it depends on the function f, but usually you can apply it in the functions that are usually given. It means that all the time, the quantity of currency 0 must be a given function of the quantity of currency 1 at all times. So this fixes the price if you think about it. Okay, usually in the case of Uniswap, for instance, the function is as simple as a product. So you want all the time this product to be constant. Okay, it's not all the time, because when people supply reserves, there is some kind of homothetic change, but if you think between 2 times when there is a liquidity provision, it works like this. Just to show you, and if you study quantitative finance, this will remind you of the absence of arbitrage opportunity. If a client wants to sell delta Q0 coins of currency 1, okay, so sell to the IMM, then this client will receive delta Q0 coins, and this has to be like this. You need to have that the quantity after your trade is equal to a function of the quantity of currency 0 is a function of the quantity of currency 1. But remember that QT0 was psi of QT1. So if you want a price that is the number of Q0 you will receive per unit of Q1, this is exactly a price, okay, then you can write it this way. Well, send delta Q1 to 0 and you get something which is like a derivative. Same thing the other way. If a client wants to buy delta Q1 coins of currency 1, then the payment will be of delta Q0 coins of currency 0, okay, to satisfy this. And you can find a price. The ratio of the two quantities is in fact the price. Here, the price of Q1 in terms of Q0, okay. For 1 unit of Q1, how much you get of Q0, okay, and you see something like this. So if you send delta Q1 to 0, then you see that the price, if there is a price existing somewhere else, there would be an arbitrage if ST differed from. So here there is a minus if you do the Taylor expansion, or if you look at the definition of a derivative, it's minus the derivative of QT1. So basically, if you think about it, if you have QT1, you have QT0, because QT0 is psi of QT1. But if you have QT1, you also have S. So in fact, you can compute your PNL. And here, to compute this in a smart way, I use something in math which is called the Legendre or Fenchel-Legendre transform of the function psi. It's a tool that we use in convex analysis. If you have done a bit of optimization, maybe you have met this object. So it's called dual transform, or convex conjugate, or Legendre transform, or Fenchel-Legendre transform. And basically, the PNL of a liquidity provider, okay, can be expressed as a function of the evolution of the price, but we can assume that the price is exogenous. Okay, there is a price that exists, say, on Binance or on Kraken, and of course, what happens on the AMM should be in line, otherwise there will be arbitrages with what happens on the other platforms. Okay, so it's something like this, and it seems, I mean, it appears that it's well expressed as the dual conjugate, the convex conjugate of the function psi that defines the AMM. But there is interesting that we do not have in the case of market making, is that if you want to contribute, if you want to be a liquidity provider, if you want to put your coins into a pool, then you need to compare the performance you will get from the performance you would have got if you stayed outside of the pool. And this is called the hodl strategy. It's like hold, it's like buy and hold if you wish, but there is I mean, in cryptos they have like play on words, and there is this thing. It's a slang that is called hodl. It's the strategy which consists in doing nothing, and of course you are interested in this PNL that you get is above the PNL of not going into the pool. And the surprise is that it's exactly the contrary. Okay, so the PNL of putting money into a pool, okay, is less than the PNL of not going into the pool. So you can ask myself, but why do people do that? Well, they do that because of transaction cost. Here in the story I gave you, okay, there was no transaction cost. In practice, here you are exposed to a negative PNL compared to the PNL of, basically compared to your outside option. This PNL is negative, and it's negative because this is just a convex inequality. It's negative, but it's in fact an option. If you are familiar with the Greeks, here you see, but this is a linear part, and here it's a minus a convex function of minus t, so it's a concave payoff. It's a concave and negative payoff. Okay, and basically you are exposed to an option payoff with a negative gamma. Okay, and this is called impermanent loss, because basically you wouldn't lose anything if at time t, st was equal to s0. So it means that basically if the price oscillates slowly around the initial price when you put the money, then you're going to have a tiny loss here, okay, and you will have a lot of transaction cost, okay, because you are the liquidity provider, you get the transaction cost. Okay, so that's good for you. But if the price really goes away from S0 and cryptocurrencies are not the less volatile markets, okay, but then you will lose money. So this is not really satisfying, and some people argued using Ito's formula that you can decompose this, but this is true, that you can, it's just an Ito formula, that you can decompose this payoff into two parts. One part that depends on the movements of price, and one part which depends on the quadratic variation of price. So this is something that you can't avoid. Okay, you need to pay for this. And this, theoretically, you can hedge using this delta, if you wish. So it's like an option you can hedge, okay? But here there is a cost to pay, okay? Because it's not a martingale, yet there is a cost to pay, okay? It's a super martingale. You have to pay a cost, and this cost is linked to the fact that you let basically the liquidity takers, okay, do the price discovery, okay? You are completely passive, okay? And you need to pay for that. Okay, you can theoretically hedge, but it's not clear how to proceed, because it's something, it's not like an option where you can hedge, say, once every day or twice a day or something like this. Here, there are a lot of transactions. So at which frequency can you hedge? On which venue? How to proceed if you really want to be like in an AMM, you need to write, you need to write a code in Solidity to do that, and it's not clear how to proceed. Is it also desirable for an LP? Because if you are an LP, maybe you are exposed to several payoffs because you provided liquidity to many AMMs, and maybe you don't want all the AMMs to hedge anything, okay? And you want to hedge at your level. And of course, like for like the classical criticism on Black and Scholes, there will be some feedback effects of this hedging, and you need to take that into account. So I'm not really convinced by this idea of that you can hedge your position here. But this is an argument, and an interesting argument, that has been put forth. And as I said here, there is a term that is non-positive, and it's the price to pay to let the LTs carry out price discovery. So this is what is on the market in some sense. You have Uniswap doing this. They propose to reduce the risk faced by liquidity providers by doing what they call concentrating liquidity, meaning that you will propose basically your coins, but just in an interval of price, okay? And this is an interesting idea, but you need to have active LPs in that case, because if the price went somewhere else, okay, but then your liquidity is stuck here and you need to remove it, replace it at some point, you need to be active. And that's not basically the philosophy of an AMM. You just post your liquidity and you wait for the yield to come, in some sense. So in the paper we wrote with Louis Bertucci, Philippe Bergot, and David Bouba, we explore, inspired by Valentine Stoikov and everything we did in FX and corporate bonds and so on, explore AMMs in which the pricing function uses some information from another trading venue. So price discovery is not left to LTs. We will import some price from another venue. It's called an oracle, a price oracle in the field of cryptocurrencies. And if you think about it, it's quite similar to the situation of a traditional market maker. Remember, I talked about a reference price, the price on EBS, the price on Refinitiv for FX, the CBBT or the CP plus for prices in corporate bonds. So it's quite natural to have this, and there are companies providing price oracles. So why not using that? And so what we did is to build a mean variance framework like Markowitz, if you wish, classical portfolio theory, in order to compare the different AMMs. Okay, and this is a specificity of cryptos. We want to compare the PNL, our PNL, to the PNL of the biennial strategy, because this is the natural benchmark. Okay, so let's assume we know everything, we know where the price is. We are in a perfect, quite unrealistic, but we are in a perfect world where everything is known. So let's assume that the price follows geometric Brownian motion with a drift. I will assume some technical stuff that transaction sizes are labeled in currency 0. When you have several currencies, it's everywhere in finance, this problem. You need to choose a currency which is your accounting currency. Okay. Well, if you live in Europe and you invest in the US, your performance is the performance in euro of your investment in the US. Okay, and that will not be the same performance as somebody in the US with the same portfolio, because at the end of the period, it doesn't change USD against euro to have the performance. So every time you need an accounting currency, and I will assume that transaction sizes are labeled in this accounting currency. And the trick in the model is to decompose the transaction into two parts, one part linked to the reference price, and one part which is a markup like the delta in the Avellaneda and Stoichkov model. Okay, so an example: if a client wants to sell Z coins of currency 0 at time t, then if the reference price is S, Z divided by ST coins of currency 0 will be offered to that client, and basically the delta in Avellaneda and Stoichkov, we will ask Z times delta extra coins. So delta now is in beeps in some sense. It's not in currency of currency 0. It's in the model only. Reality is slightly different, but that doesn't change anything for it's just better for the math, but that doesn't change anything for the analysis. And so I can write exactly the same equation as before. And here I will assume that there are several sizes instead of one sizes. So complicated equations, because you don't have a simple point process. You have it's a measure, it's a random measure that depends on the size. Okay. So don't focus too much on the equation. This is basically every time you trade, you make money compared to, I mean, you make the markup. Okay, your reserves, but every time you buy currency 0, you have more zeros and less 1. Every time you sell currency 0, you have less 0 and more 1. And this is exactly what it says. It's just a bit complicated the way it's written. And of course, I will assume, as in Avellaneda and Stoichkov, that people come to trade with me as a platform. Okay, depending on the price I quote, and the price I quote will be S plus. Did I write it? No, I didn't write it. So it's going to be, no, it's not written. So it's S plus delta. It's not S plus delta. It's S times 1 plus delta, if I'm not mistaken. So it's multiplicative, but it's almost the same as in Avellaneda and Stoichkov. And so it's kind of the same model, but I need to take account of the benchmark, and the benchmark is ODL. And if I look at the equation, it simply consists in replacing all the inventories by inventories minus inventories at time 0. Okay, so I can write all the equations, PNL minus PNL of ODL, write basically all these spread capture terms as before. Here it's the risk term, okay, exactly like in Avellaneda and Stoichkov, and I can optimize. But the problem is, in Avellaneda and Stoichkov, I could go short or long. Here, well, I can't sell something I don't have, so there are some constraints, okay. But if I want to start with a simple model, forget about the constraint and assume that I'm big enough and I control my risk quite well. Basically, when I sold something, I want to buy it again, and when I bought something, I want to sell it again, so that basically I will be in a situation where there will never be a situation where I'm missing one of the two assets. There is no depletion in some sense. So if here there are too many state variables, it's intractable numerically, but if I remove this constraint, it starts to be an optimization problem with only one state variable with a Markovian dynamics. And so if you know stochastic optimal control, this is the best case you can imagine, you have a crazy equation. Here it's a PDE, but it's even more than a PDE. You have partial derivative with respect to t, partial derivative with respect to basically it's your quantity in asset one, okay, in currency one, but accounted in currency 0. And you also have non-local terms like jumps. So it's a complicated equations to analyze, but if you know how to solve the PDE numerically, you can solve this in the same way, okay? And you have the optimal quotes exactly as in Avalanche and Stoikov. So we played that stuff. We built a market simulator for USDC and ETH. We just took some example with a single transaction size, and we looked at what happened. We calibrated a bit some parameters, and we looked at what happened. And here, basically, here there are existing AMMs with different parameters. And here it's the standard deviation, so the risk, and here the return. They perform really well, really badly, sorry, okay? And here in green, this is the best I can do with my strategy, okay? And my strategy depends on risk aversion. There is a risk parameter, okay? And so when I vary the risk parameter, I have a frontier, an efficient frontier here. And here it's what would happen if, but this is only okay for perfect information, when I just have a constant delta. But of course, if I don't know exactly the price and somebody wants and deplete everything, arbitrage me, I will be left with only one asset, and this is something this is something not realistic, but true here in this perfect world. So what we did is we looked at misspecification. What happens when we have partial information? If we are wrong on basically the flow of clients, then it's not problematic. It's just that we are going to slide along the efficient frontier. Okay, maybe we thought we would be here, but we are there. It's not a catastrophe. Same thing for volatility. If volatility is more important than what we thought, well, then we are simply going to slide on the efficient curve. What is more important, and this is really something we insist upon in the paper, is the question of oracle. Once again, I don't know where the market is exactly, if that makes sense, but I have a price oracle. But what happens if the price oracle is lagged, or if there is noise in this price oracle? So in fact, I will ask prices at discrete times. Okay, and here we looked at what happened. This is the efficient frontier in the perfect world. Okay, but here it's basically what happened when we are lagged by 10 seconds, 30 seconds, 1 minute, 5 minutes, 30 minutes. Of course, if we have a delay and we don't know where the price is, we are offering stupid prices to people. And sometimes we are proposing very bad prices and nobody comes. And sometimes we are going to propose very good prices and people are just arbitraging us. Okay, but even when we have a 30-second delay or even 1 minute delay, we are really better, if you remember the figures, than the classical AMMs that are used today. So this is an interesting finding. So it's quite robust to the delays in Oracle. Also, we added some systematic arbitrageurs, people that can arbitrage us. There are already some arbitrage in the model, statistical arbitrage in some sense, but people that can come, people that come because of this the lambda function, the intensity function, but it's not systematic. It's more probabilistic. Here, it's in a systematic way, and that doesn't change much. And somehow, even they protect the arbitrager, they protect the AMM against arbitrages by probabilistic arbitrage. Arbitrage by classical clients that would make more money than this arbitrager, which are more systematic. So it's quite robust. And here, with arbitrageurs, with a delay, I think of 10 seconds, we plotted everything. So here it's basically where we are in the model. These are the classical setup, and here the star is some model that was proposed before we met by the swap team. Okay, and you see they are really close to the efficient frontier. They are on the efficient frontier somehow here, but it's really low risk and low return. Okay, and today they are inspired by what we proposed, and they proposed a new version of their tool, of their AMM, and we are still working to improve that and add new features. So the main results, if you are interested in DeFi, is that traditional CFMMs, they perform poorly relative to the efficient frontier. So we can really do better than what we have today in terms of mechanism. And one way is to get information through an oracle. But of course, although it reduces the volatility and deliver a positive excess P&L, it comes at a cost, okay, which is that you have to have a good oracle, which is carefully designed, and every time you have an oracle, you have the possibility to have new attack vectors. So of course it's more complicated, so it's less robust in some sense than a simple AMM. So there is a trade-off, but we think, and I think that it's worth it, because the P&L is really improved for the liquidity providers. A general conclusion may be, before I take your question, and I think I'm on time, market making models, they are quite important for OTC markets and crypto markets. There is still a lot to do. I told you that there are some improvements, but there is still a lot to do, especially for adverse selection. This is a very important problem when you trade with people that are more informed than you are, how to protect yourself against trades that are somehow toxic for you. Okay, this is a very important area of research with really concrete applications. And that was more for classical markets, traditional markets, but also for DeFi. And if you are interested in AMMs, well, there are people in France like me working on this, but there are also some groups that are quite active. One in Berkeley, and a very important one at OMI, Oxford Man Institute. They really invested that field, and try to follow them at Oxford Man Institute. They really do great job about DeFi and AMM. Okay, so I'm open to questions if you have questions.
Yeah, I think Yad had a question.
Yeah, thank you for the presentation. First, I wanted to ask you if there was any difference between the AMM and the classic dark pool. I mean, from what I have understood, you just get the order flow, base yourself on the price you get on a lit order book, and then you try to offer liquidity to other market participants, which is the concept of a dark pool, no?
Well, it's not the same thing as a dark pool, because in a dark pool, there are two things. First, in a dark pool, it's dark, so the liquidity is not visible. Here, everything is visible. Okay, in a dark pool, everything. I mean, the price. Say a midpoint dark pool. The price is imported from. The main venue. Okay, so say from Euronext or from the NYSE or stuff like this. Okay, here the price is based on the mechanism. So true, there are people providing liquidity and people taking liquidity, but here somehow the pool is never empty. In a dark pool, the dark pool can be empty. If there is nobody, there is nobody. So for me, if I want to use an image, a metaphor, a dark pool is like a pool, but somehow you can be the fisher or the fish. Yep. Meaning, if you post some liquidity and there is nobody, maybe you wanted to be a fisher and find if there were some fish, okay? But you can decide to, it's hard in real life, but you can decide to become a fish and wait for a fisher in the other direction. Okay, yeah. Here it's really different. You have LTs on one side, liquidity providers on the other side, and they are not the same person.
Okay, and another question, did you consider modeling the price based on other models? Because I saw that you used the geometric Brownian motion.
Or you can generalize what we do. This is something we do. I just don't present, but you can imagine all your favorite models. Maybe not all, but you can imagine your favorite model and adapt market making models to your stochastic volatility model you like. I mean, I'm not sure what you had in mind, but if you have a stochastic volatility model in mind, you can have it. The only thing is that usually stochastic volatility model is Markovian, but it's in dimension 2.
Yeah.
Okay. You have the price and the vol, say, or the price and the variance. And so in the PDE, you have one more state variable, so it's more complicated to solve. And if you, yeah.
Okay, thank you.
It comes at a cost.
Are there other questions?
Yeah, and sorry, I had the last question. So generally in the stochastic optimization problems, you have the problem of the dimensionality of your variables.
Yeah.
And so what drives the model is actually what the researchers can solve in terms of PDEs.
So this is something. So the FX case, the model we have is a model with Alexander Barzikin and Philippe Bergot. We proved we have PDEs in dimension 50. So of course we can't solve. I mean, some people are claiming they solve PDEs in dimension 50 using neural networks. It's not wrong, but it's specific and it's slow, and this is clearly not what we need. Okay, but we have some techniques, which it is a technical. I mean, called. It has no name, but it's really the reduction of a PDE, Hamilton-Jacobi equation, to a Hamilton-Jacobi equation associated with what we call linear quadratic control. Yeah. And basically, there are two kinds of Hamilton-Jacobi Bellman equation that we know how to solve, and the most common one are those associated to LQ control, because linear quadratic control, because they boil down to Riccati equations. And Riccati equation, it's not a problem. Even in dimension 50, it's your object which is in dimension 50. It's not, you don't differentiate with respect to 50 variable. So so this is something we proposed to approximate the solution, and it works. What I presented to you, the video, was based on the approximation, not on solving the PD. We tried in dimension 10, and we have no problem. It's almost instantaneous.
Okay.
But to answer your first question about the other models, of course, in that case, you have PDEs in higher dimension, and it's more complicated. You have the curse of dimensionality.
Yeah.
So you need tricks.
But I mean, if you run a neural net on those PDEs, you would still have an approximation while taking into account many other features that would.
Yeah, but I'll tell you something. All these things about neural networks to solve PDEs in finance, they are, I mean, I don't trust them. Why? Maybe they are right 95% of the time. But guess why? When they are right, nobody will trade with you because you are at the right price. But if you are wrong 5% of the time, it's not like you are wrong of 5% and it has no consequences. It's like you predicted it would be 21 degrees and, oh, it's 22 degrees. Oh, nobody cares. But here, you will trade only when you're wrong and you will lose money. Okay? Yeah. So be very careful when people are saying, oh, like fast pricing or high price with no. Maybe you can use that to simplify the risk procedures in the bank to have approximate prices and stuff like this. But when it comes to trading, adverse selection, you will trade only when you're wrong and wrong in the wrong direction, if you wish.
Okay, thank you.
It's indeed a very interesting point. Are there other questions? I mean, I imagine that Yet still has like 10 questions on his list. But no, thanks a lot, Olivier, for the presentation. It was very nice. I did enjoy it, and I think the rest also enjoyed it. Yeah, thanks again for making time for us. And
if people like in the live stream have questions, I mean, they can connect with me on LinkedIn. Usually I answer questions, and so they can always try.
Yeah, indeed. No, but thanks a lot, and then I wish everyone a great evening left and a great rest of the week. Thank you.
Thank you.
Bye-bye.
Bye.
Thank you.